The All-In Summit in Montreal around AI and innovation was happening. And AI Minister Evan Solomon came out with the news on his new AI strategy task force, a 26-member dream team, as they call it, tasked with revamping Canada's national AI playbook in just 30 days. And they've had some heavy hitters in the Canadian ecosystem join this group. Novia's Patrick Pichette, Cohere's Jolie Pinot, Build Canada's own Dan DeBow, your good friend from CCI, Ben Bergen, and many others joining this group of heavy hitters. I think the focus is going to be around research, talent, commercialization, safety, education, blah, blah, blah. And Evan Solomon calls this the second great technological revolution in the last quarter century.
One of the biggest criticisms we have had for the last, frankly, decade is Canada's stubborn refusal to engage the private sector in serious public policy matters. So give Evan a big check mark for doing that. The question will be, they want to present something on this budget. Is it a little bit too little, too late? I don't know.
Hey everyone, before we dive into today's Tank Talk, a quick word from our sponsor, Fasken. If you're an early stage founder navigating the legal side of startups, chances are you'll need someone like Will Shaw in your corner. Will is a partner at Fasken, and he is here to help us break down some of the common startup legal questions we get all the time. Will, thanks for joining us in the Tank today.
Thanks for having me, Matt.
Will, a lot of early stage founders that we deal with at Ripple, and obviously you deal with on a daily basis, are debating so many different things when it comes to working with investors and partners. The first thing we always ask is, should I raise a safe note or go after a priced round? So first off, what's your perspective on this, and what are the key differences a lot of founders should know about the two?
Yeah, safes are definitely faster, but they kick the conversation down the road on a few important things. Like, for example, a safe will defer setting a valuation, which makes things simple up front, but it can lead to unexpected dilution down the road if you're not managing your cap table. A price round is setting the valuation now, so everybody knows what they're going to own in the company, but it's also giving away a little bit more in the sense of rights. So a founder really needs to watch how much their dilution they're taking on, and also think about what rights they're giving away and what the timing is for crystallizing all of those things.
Right. And there's a lot of these in-between things that people also try to jam into safe notes because they are a little bit faster, but they want a little bit more protection, which we call side letters. So we hear about them a lot, Will, especially in more competitive rounds. What are some of the factors that founders should think about and look out for when an investor asks for a side letter?
Side letters can be useful, especially when the safe is a standard form. And exactly to your point, Matt, you're trying to get other rights in there. So they can give specific rights to special investors, like pro rata rights or extra information or board observer seats that aren't in the main deal. But founders should make sure they're not creating long-term risks or burden or giving one investor an unfair advantage that might scare off future investors.
Yeah, I know. We definitely obviously like having side letters as well, being institutional investor where safe notes may be a faster path, but there are certain things that investors need to have in protection when they're not doing a price round. We have worked together on many transactions with you and your team, Will. You guys have been fantastic partners of ours, but a lot of things that happen at the beginning of a company's journey kind of end up biting them in the butt on the other side when they either exit or sell the company. Many think about acqui-hires or M&A transactions, and we all face it. Not every company is going to go public. They often get acquired early and go through these acqui-hire scenarios. What are some of the things that founders should think about from a legal standpoint, if they're going forward with an acqui-hire or some type of M&A transaction?
Just start early. Keep track of your documents as you're going through things. Make sure they're in a data room. Make sure your IP is properly assigned. You make sure your contracts are clean. There are a lot of things that are simple to do at the time, but are really difficult to fix later on. And an acquirer is going to dig into everything, especially IP, the team agreements. If those aren't buttoned up, you're going to lose a lot of leverage and you may end up killing the deal.
Yeah, these are awesome insights, Will. Thank you so much to you and the Fasken team for supporting Tank Talks. All right, now let's get into today's episode. All right, John, welcome back to the Tank here. After last week's episode, There was an interesting podcast that came out on the BG Squared podcast. That's the Brad Gerstner, Bill Gurley podcast, where Jensen Wong came out with his vision. And what he talked about, which was really fascinating, and it kind of unpacks a lot of what we have been talking about in terms of the overbuilding of GPUs. But he really focused in on this, AI trajectory and how, it took 20, 25 years to get everyone to the cloud and get the entire world, 4 billion people on the internet. And now you're doing this CPU to GPU switch and, sort of hammering home this like general purpose computing is over due to Moore's law stalling and basically pushing the world towards this accelerated computing and AI. And what he was saying is there's insatiable demand for this compute. But the biggest hindrance, and you and I have talked about this, is energy here, right? So I just wanted to kind of break down what you wrote about on your last piece here in terms of Canada's moment to shine, in terms of filling this gap, in terms of gigawatt energy potential, and how even the visionary Jensen lays it out and says, we will have the compute needs and already see the demand for compute needed right now. The biggest gap will be the energy being able to fill the other side of it.
Yeah, well, I mean, what a great opportunity for Canada from the energy angle, and not just stopping there at the energy, but you have the energy, you match it with the data center capacity, and ideally create an app layer in that data center so that you're doing your own inference or whatever the activity is in Canada. But yeah, you're absolutely right. The key here is the energy capacity. It is the true impediment. And right now, when you run the math, you really can't meet the expected supply without having the energy sources, because it doesn't just occur overnight. That's issue number one. And issue number two, again, as you and I had talked, eventually the subsidization on the revenue front, i.e., using venture capital dollars to decrease the cost to consumers of this, when that goes away, the real question will be is how much will consumers, whether that's B2C or B2B, play, and what economic value are they receiving in connection with, call it the non-subsidized cost.
Well, you say, VC subsidized dollars, but as we talked about last time, about 80% plus of NVIDIA's revenue is from the top 6 hyperscalers. Those aren't startup dollars, right? We're talking about Meta, Google, Facebook, or Amazon, Microsoft. They're the ones buying out all this compute and giving out these $20 billion contracts to these neoclouds, as well as for their own benefits, and buying these GPUs to be able to meet up with the demand. He's saying there's no glut or bubble, but you're saying you think there is?
Because you can't stop there. So who's the customer? It's OpenAI. It's Anthropic. It's
well, Microsoft has their internal uses and their end customer uses.
They do as well. But the venture capital dollars, the estimates in a 4-year period of time is going to be $1 trillion. Again, if one of my partners, Peter Shee, wrote a post on this very issue. You have to look at the circularization of the funds flow, and the gap is ultimately being filled by capital. It's not only VCs, it's sovereign wealth funds, etc. That is a big question still. And again, if that money were to go away, then you ask yourself the question, okay, then where does that, who ultimately will foot the bill? And ultimately, at the end of the day, it's going to be the consumer, whether it's B2C or B2B. And then the question is, they're going to have to make a value calculation, based on the demand compared to their perceived economic value that they're going to derive.
Well, Jensen talked about that as well, that $1 trillion revenue number that people are saying needs to be generated in order to justify the CapEx build out for all of these data centers. Right. And he didn't seem to shy away from us getting there very soon. I spoke to a friend of mine who works at one of the largest private credit shops, who are basically at the epicenter of these capital providing loans. And he explained to me how this is actually happening. And it sounds quite logical. You've got Meta doing a $14.2 billion deal with CoreWeave. You've got Nebius getting money from Microsoft in a $20 billion deal. you have all of these large hyperscalers buying up as much compute as they can in forward contracts. And these these neoclouds are basically saying, okay, well, we need the capital to go and build these data centers and secure these chips. And that's where the Blackstones jump in and these other large credit providers. So there is capital. Capital is available for this opportunity.
To the hyperscalers for sure.
And the neoclouds.
Yes, but because they have a business
contract.
Right. Well, it's not a hard. So go and look at the OpenAI contract with Oracle. It is completely contingent on the acquisition of an energy supply. And if you actually see it, it's based on a I think it was a per gig. I can't remember what it was. So they already acknowledge in the contracts that
there's certain milestones that have to be met in order for them to collect that revenue.
Right.
But my point is, if there's three pillars to these contracts, there is securing the chips, which NVIDIA is very willing to supply them on. Securing the capital is obviously able to get there right now. And then building out of the actual data center and the energy. Well, that's the last one.
That's a fourth pillar.
One. What's the other one?
The ultimate consumer demand for it, and at what price?
The demand is there, is what we're hearing. The demand is currently being there.
You don't know yet until it happens on a non-subsidized basis, is my point.
But Microsoft's using it for themselves. They have the demand for themselves.
When you use ChatGPT at $20 a month, let's talk as an average person at $20, right? And if I said to you, what happens if that's 500 or 5,000 or 50,000 a month? Does your view change? And your answer is, yeah, it might. Your answer might be it doesn't change. All I'm just saying is take away that subsidization. And then I just don't know. The same thing happened on the obfuscation. Again, I'm an old guy, in the late 1990s with the build out of fiber.
Yep.
And replace these new cloud providers with the CLECs. So you know what we had? We had the incumbents, which were the telecom companies. And then we had these CLECs that were competitive local exchange carriers. They were financed by like the Blackstones of the world were financing their debt. Who were their customers? Were the startups. Eventually the startups couldn't pay for it anymore and they went bankrupt. I'm not saying it's going to happen, but being there before, you kind of see where the tip of the spear is. It's ultimately what triggered it was the blow up of the .coms triggered the whole cascading effect. So again, if they're able to build this out and the value is fully there to justify, then you're absolutely right. And this is why I say I'm optimistic in the medium to long term, because I think it does take a while to figure out what is the value proposition. But on the short term basis, I would just say that there seems to be a dislocation, just purely from a mathematical perspective.
Yeah, I mean, Jensen said that the hyperscalers are under forecasting. Annual chip cadence per watt, is extremely sensitive, right, to how much watts you can put into these places, and they're trying to get more efficient. But the depreciation of these GPUs is also an issue. These things depreciate 70-80% in value over 3 years.
3 years.
3 years. So you're putting a lot of money into something that doesn't have a huge lifespan to it. But speaking of which, the information had a scoop on the earnings of OpenAI for the first half of the year. September 30th, they had their H1 financials via shareholder disclosure show $4.3 billion in revenue, 16% more than 2024, putting them on track for $13 billion full year run rate, about $1 billion a month. But the burn is hot, $2.5 billion.
Whoa,
$2.5 billion with $6.7 billion in R&D, doubling 2024's pace. So $2 billion in sales and marketing, up 2x. Including some Super Bowl ads, $2.5 billion in stock-based compensation. That's doubled.
Yeah, so you got to take that out a little bit. But that's a cost. It is a cost. It's a cost of dilution for sure. But you're right. It's not a direct cash cost, but it's a cost.
So $17.5 billion is how much cash they had at the end of Q2, bolstered by that $10 billion funding round they did. Operating loss of $7.8 billion. They're basically projecting, though, to hit $200 billion in revenue by 2030, 115 of burn through to 2029, and $450 billion in server costs, mostly renting.
Well, at the rate that they're going at a 200 billion of revenue, it might be 300 billion of losses.
Well, that's my point. The $100 billion LOI from
Yeah,
NVIDIA is a drop in the bucket.
I'm just saying is that, ultimately when the unit like right now, their unit economics are negative, right? And again, you could just say that's a temporary dislocation. Is as long as the wheels don't fall off from a capital perspective, you can keep on going until you get there. But this is again, I'm not predicting one way or the other, but when a guy like the CEO of NVIDIA is promoting that this is endless, well, look at who he is and what he represents. Of course, he has to say that as well too. But again, I say this with the short-term concerns, but with medium to long-term optimism.
Well, let's take it to north of the wall here for a second here, John. The All-In Summit in Montreal around AI and innovation was happening. And AI Minister Evan Solomon came out with the news on his new AI strategy task force, a 26-member dream team, as they call it, tasked with revamping Canada's national AI playbook in just 30 days. And they've had some heavy hitters in the Canadian ecosystem join this group. Novia's Patrick Bichette, Cohere's Jolie Pinot, Build Canada's own Dan DeBow, your good friend from CCI, Ben Bergen, and many others joining this group of heavy hitters. I think the focus is going to be around research, talent, commercialization, safety, education, blah, blah, blah. Yeah. And Evan Solomon calls this the second great technological revolution in the last quarter century. Yeah, no shit. So the question really is, what will they be able to accomplish in 30 days? What they haven't been able to accomplish in the last, 3 years since we already knew ChatGPT was already out.
All right. So are you really going to poke me as the cynical guy here?
No, I just want to know what you can do in 30 days.
Nothing. Really. I've been on these are, first of all, it is an outstanding crew of folks. They did a great job on that. But 30 days, how many meetings are you going to have in 30 days? 3, maybe, something like that. Now, what's, for the last 6 months, it's not like they've done nothing either. At least you hope not. And, there's been lots of behind the scenes discussions. So what you can do really in 30 days is really discuss what the government is really thinking of doing. They do have, I think, was 5 or 6 breakout task groups that will go through each of the areas. But, my guess is it's been somewhat pre-shaped, and it's a little bit of a sounding board. If they get something really off, you would expect that group of folks would be pretty vocal about it. But it also gives a little bit of air cover to the government, because one of the biggest criticisms we have had for the last, frankly, decade is Canada's stubborn refusal to engage the private sector in serious public policy matters. So give Evan a big check mark for doing that. The question will be, they want to present something on this budget. Is it a little bit too little, too late? I don't know. But I'll give Evan the credit of being really one of the first ministers, maybe the first minister, to truly engage and with a great group of private sector folks.
I think it's a great initiative for sure, bringing in some of these heavy hitters and obviously trying to create this Canada first approach to AI. Obviously, everyone's talking about, the sovereign identity that we need to have along the sides of fast tracking the ecosystem, right? But I think there's also the pressure for them to deliver something. And I just think that by putting this 30-day timeline, it puts them in a bit of a crunch to deliver something when they probably shouldn't have done that, I think, is my point.
Yeah, I guess the question is, what does deliver mean? Is deliver saying we are going to do something like this and now we're going to go and work through the details? The thing that I really did like what Evan had stated kind of as the introduction, the objectives were outstanding. The message has been delivered. the focus in on Canadian and digital sovereignty. We haven't heard those words in years, right? That's what I was particularly thrilled about.
I think there's three things they should focus on. We kind of just talked about at the top of the show. We need to talk about energy, we need to talk about talent, and we need to talk about capital. If the three of those things can be solved, as in government comes in with good capital providers and incentives to provide capital, talk about energy production to get this energy up to the level of gigawatts they need, and also get ways into attracting talent back into the ecosystem to accelerate talent into this ecosystem, is what I think their three main focuses should be. So if anyone's listening, those are the three things I should, I would talk about.
And by the way, when you say capital, I include procurement in that, but that's just a different way of getting capital.
Yeah, absolutely. Right? This is an interesting story that I saw, but I think you would have an interesting take on, is the SEC's push to tokenize stocks. Basically, the regulatory green light is moving through here, and SEC Chair Paul Atkins is fast tracking a plan to let stocks trade like crypto on blockchain, granting exemptive release from some traditional rules. Now, example, best price guarantees, conflict avoidance, to kickstart the tokenization of equities. Obviously, Trump's crypto agenda is pushing this forward, but interesting to see big, heavy fintech, players like Citadel pushing back on this. Traditional finance players essentially trying to put their own stamp on this and saying, back hard. I mean, listen, Citadel Securities handles 35% of U.S. retail trades. So they're pushing back, warning of investor harm, liquidity fragmentation, and the risk from offshore access or SPV structures that could deny dividends or expose funds to failures. So I think this is a move that they should be making, or at least having the conversation around innovation in our securities industries. I wish Canada would have something like this, but maybe they need to unify the security provincial players first before even having this. We don't even have an SEC. So what do you think of this, John? Is this a good bridge to kind of bring mainstream onto the blockchain adoption?
In the article that I wrote, this is what I included. It's the tokenization of all of your assets, starting off with payments, i.e. the stable coin, and tokenized deposits. Those are only the first two, but it will be tokenizing everything. The obvious one is securities, land, the interest in your fund and the interest in my fund. All assets will be tokenized. What's interesting to me, so let's just talk about, the first three, which are the biggies, including the securities. Who barks the loudest? Well, on the stablecoin payments / tokenized deposits, it was the banks, because of the fear of the run of their deposits that would not be competitive. Hence why they had to tokenize the deposits. In the securities front, you had Citadel. Why? Because they get to lose their big clipping fee for the custodial work that they do on stocks. And I saw the explanations. And again, I am not an expert on it, but I just thought it was a very odd excuses that I thought were very addressable using blockchain rails. And here is the third one. Did you see Swift coming out with their own proprietary blockchain? Here is the most archaic payment system in the last God knows how many years. And the stable coin is an attempt from a B2B perspective to disrupt it. So what's fascinating to me is all the incumbents are very clearly saying, holy crap, this might ultimately disrupt the enjoyment of my monopolistic or oligopolistic behavior that I've enjoyed for the last number of decades, and it's now under attack. That I find fascinating.
Well, you just got to follow the breadcrumbs, John. I think if my time working in finance and capital markets, I saw exactly how slow the process was. You got T+3 settlements. Okay. So you get rid of that with tokenization, instant clearing, instant settlements. Okay. Then you have tracking of shares going in between the clearinghouses, right? You got DTCC, the large clearinghouse of securities. You also got the short sellers, right? Who are doing naked shorts. Now you have to put in a code to show how much shorts you've borrowed.
I didn't think about that.
So the tokenization part is a really good way to clean up the messy gray areas in capital markets.
Is interesting.
Because the prime brokers make a lot of money on lending out shares that they control through their retail channels. And Citadel who does 35% of US retail trading, has a huge swath of shares that they can also put out for hedge funds to short and earn a fee on top of. And so if you tokenize it and maybe somebody owns their securities outright and I can loan them, there's no spread takers in that business model. So if I own shares of Google or whatever it is, and I don't, want somebody else to make money off my share sitting in my retail account, I should be able to put them out onto the chain for somebody to borrow, to short, and I collect the VIG off that.
And don't we eliminate all of the concerns when something is has multiple collateralizations as well too? Because now there's one unified ledger, and if you have to go back to the ledger, you can't recollateralize securities. That was
the whole global financial crisis issues, right? The multiple shorting or CBS,
That's fascinating.
CBS and all that.
It's a great point that I'm going to add.
So we'll have to see you until next time, John. But thanks so much for joining us in the tank, as always.
All right. Thanks, Matt.